Well, there's plenty going on this week, including a partial government shutdown, earnings season. It's a big week for earnings. About one quarter of the companies in the S&P 500 are reporting this week. We saw 20% or so report last week. The nomination for Fed chair last week, who will ultimately replace Jerome Powell when his term expires in May of this year. All of that's important. We could certainly cover an episode on any one of those topics, but this week I want to talk about something different. Last week I received a couple of questions about one topic in particular. I figure if I'm getting these questions, then others must have it on their mind too. And that topic is foreign holdings of US Treasuries, and specifically whether foreigners are starting to dump their Treasury holdings. This is something that comes up every so often. So this is not the first time. But the reason that it was in the news most recently is because many started to, right around the time of the World Economic Forum in Davos a couple of weeks ago, many were starting to float this idea of the nuclear option, of whether many of the largest foreign holders of US Treasuries would look to dump their Treasury holdings in response to the threats towards Greenland and the possibility that the US might look to take over Greenland by force. And right around that same time, we got news of two pension funds, actually one in Sweden and then a Danish pension fund, and they announced their plans to fully exit their Treasury holdings. And so collectively, those two pension funds own about 110 billion in US Treasuries. That is not an insignificant amount. Certainly in absolute terms, that's a lot of money. But in terms of the total supply of US Treasuries, that's really just a drop in the bucket. So what I want to look at is just the broader data. And what we see here is that, at least with the most recent figures that we have, this is as of November of last year, we see that about $9.3 trillion of US Treasuries are held by foreign investors. This number has actually been growing in recent years. It's actually at an all-time high. So I think that's very, very important. It runs counter to this idea that we're actually seeing this mass selling. If we look at this on a country-by-country level, if we just focus in on the five largest Treasury holders by country, we see that most are actually growing their Treasury holdings. The one exception is China, which is not too surprising, and this is something that we've known about for quite some time. So we do see their Treasury holdings slipping. Now, at the same time, what we see is the number 4 holder, just ahead of Canada, is actually Belgium, which some might think is very surprising, and I certainly do as well. The idea there, or the thought that many are speculating about, is that this is likely a large part of the Belgian holdings is likely through China. And actually, they're still buying, but they're doing so through Belgian custodians, through Euroclear. The reason they would do this is that they would look to potentially avoid the threat of sanctions and these assets being frozen. So they're looking to diversify their holdings in other ways and kind of hide and mask their ownership. So we see here that there's no signs of selling of US Treasuries. We would also see this if there was a mass flight out of Treasuries, we would see this in yields, in US Treasury yields. And if we just focus on the 10-year Treasury yield, we see that it's been fairly range bound, around 4.2, 4.3% of late. So we're not seeing any evidence there. I think as we focus on the threat of these foreign creditors and buyers of US Treasuries going away, that vulnerability, which I think is real, I think the focus shouldn't be on the selling of current Treasuries, but maybe the lack of demand going forward. We know that the US deficits are not going away. This means that we're going to have to continue to issue debt here in the years to come. We need to make sure that as that new supply comes on market, there are buyers there to take in the supply, to absorb this, to make sure that we contain yields. That's what I'm focused on. And so we have ways of tracking this, but I think it is a very real risk. We are watching yields, certainly, but we also know that the US Treasury is constantly issuing new debt. And these are in the form of these auctions. And so what we do is we keep an eye on auctions to gauge demand. We look at things like bid to cover ratios. And this tells us that so far, there have been enough buyers to absorb this demand. But that is something that does bear watching going forward. As investors, we're often asked, well, what are you doing about this potential risk? We know it's a risk. We think the odds of flat out selling are relatively low, but we do acknowledge that it is a risk. And so, what are we doing from an investment standpoint? Within portfolios, we have an underweight to US Treasuries. We have a relative overweight to high quality corporate bonds instead. And so that's our way of saying treasuries are still important. They're still something that you do want to own in case the economy stumbles and we do see a flight towards high quality assets. But at the same time, we want to acknowledge this risk of higher bond yields if we do see less demand and more supply. And so we do have an underweight there. We also have what we call a slightly underweight duration bias. And what that means is that we have a bias or we favor shorter term treasuries and bonds in general. And because we think that in that environment, it would be those longer term bonds that would really feel the biggest hit. And so that's our way of managing this uncertainty. I know this is a wonkier topic than usual, but I thought it was an important one to mention and just highlight because it does appear to be top of mind. So I will leave it there for now. But if you have any other questions or wish to talk about this with your advisor, please don't hesitate to reach out to them. And I'll look forward to seeing you next time.